Hey guys, welcome back. My name is Jordan, and today I have a video for you about the 3 main mistakes I've made so far in the stock market. I've broken this video up into 3 categories. The first category is buying absolute garbage stocks, just stuff that you don't want to be associated with, real trash, just bad investments altogether. The second portion of this video is going to be selling too early, so buying stocks, getting the direction right, but you just cut your profits too early. And the third is going to be picking the bottom, the infamous bottom that no one seems to be able to pick. So let's jump straight into it. To allow you to overcome the steep learning curve that is the stock market, I really think it's wise if you start paper trading first before you put any money into the stock market. If you want to know how to do this, check out my first video, how to get started on the stock market for Australian stocks, and check out that video and outlines what companies are good to start a paper trading account with. To kick off the first category, buying garbage stocks, I'll just give you a bit of a background into how I got started. So I bought my very first stock about 4 to 5 years ago, and it was Fortescue Metals Group. And I purchased them for about $4 at the time. I was really keen to get started investing, wanted something that I knew a little bit about, and I'd heard the company Fortescue Metals in the news. So I did a bit more research, found it was something that I'd really like to get invested in. So I just pulled the trigger, started there. And since then, that Fortescue Metals has obviously grown sizably since that investment. As soon as I built up a bit of confidence, I started establishing a bit more of a portfolio. I started buying some gold mining stocks, bought a couple of those around that time, as I thought, gold generally over time tends to go up. So I just added them to my portfolio and really just started adding little stocks, just little bits at a time. I didn't invest, 15, 20 grand, 30 grand to start off with. It was just a couple of grand here and there, just to try and grow my money a little bit faster than whatever the bank could give me. About 1 year later, in 2017, I did a bit of research on a stock that was a bit more speculative. I got a bit of confidence, and I got a bit confident with my ability to pick stocks that were going to go up, as the ones that I had in the past were generally doing quite well. And about 1 year later, after I first started my first purchase, I picked a stock that was an oil miner. And I'm not going to name the stock because it's quite a very sad story, but all in all, I purchased this stock for about 6 cents, and I put $1,000 in. So not a huge investment, just $1,000 to get me a little bit exposed to the oil market. And I did all my research on a place called Hot Copper. Now, this is a really good website, a really good forum where quite knowledgeable people post a lot of different things about stocks, and there's some genuine gold in that Hot Copper forum. But there's also a lot of hype that people just don't have any influence on the stock market, but they seem to think this thing's going to the moon. It's going to a $10, $15 stock, and it's now valued at 6 cents. So you've got to get on before the train leaves. And it's just a place where a lot of those people can gather, and you have to filter through all that to try and get to the really good analysis. So I did that, and then as soon as I purchased, what happens? The stock starts to drop. The day after they release their results, stock starts to drop, goes down to 5 cents, 4 cents, 3 cents, 2 cents. And now currently over the years, it is valued at 0.6 of 1 cent. So a 91% loss since that time in 2017 when I first purchased. So not a place where you want to be, not at all. The funny thing is about this stock though, is that over time, I've seen it and it's now worth about $70, but every time I've went to purchase a stock, I've done my research, and every time I went to go purchase a different stock, that stock, I've kept it in my portfolio as a reminder of the risks that can be associated with the stock market, and to do research above and beyond what you think is necessary. You can't just go and pick a stock and put 10 grand on it or $1,000 on it and just pray that it goes up. That's pretty much gambling. So I keep that there as a reminder in my portfolio of the risks associated with the stock market, and to always do more research than what I thought was necessary. Now, since that time, obviously, I've made quite numerous investments, and it has saved me more than the $70 it is worth, just for the pure fact of me not jumping into things. Sometimes I've really wanted to jump into a stock and thought it was going to explode, and I've just held off for a couple of hours. Sometimes it's even a couple of hours or a couple of days, and the market provides you an opportunity to get in. So if I had jumped in at that time, I would be down quite a sizable amount, seeing as the time that I wish to purchase is considered chasing. It's after a massive spike, a massive jump in volume, massive jump in price, and that's not an optimal time to get in. Sometimes it is, and sometimes you can get lucky and it works out, but sometimes you just can be a little bit patient, wait for some of the hype to subside, and then get in on that second drop, which then you can unlock yourself into some pretty handsome profits. As I haven't sold the position, it's still sitting in my account. It's technically not a loss, and it can maybe bounce back one day, but I'm certainly not holding my breath. And as I mentioned before, it has saved me a lot more money, and just as a reminder to wait before you purchase, do your research, and make sure you're 100% confident that you're getting in at the right time. So that pretty much recaps my first experience, my first mistake of just buying garbage stocks based off hype. Category number 2, selling too early. Now, realize losses when you actually sell the stock for a loss, you actually get out. So if I sold that position in the first instance of $1,000 down to $70, if I sold that position, I would be at a $930 loss. That is a realized loss because there's no way you can come back from it once the order has been executed. Once the sale has been processed, you don't own those shares anymore. Someone else does. Now, they're quite painful. They can be pretty heavy and pretty taxing on the emotions. But something that in category number 2 is even more taxing on the emotions, well, can be, is selling too early. So when you make a prediction, you buy a stock and it goes up, you're in profit. That's one really important part. You're making a profit, and then you sell, and then the stock keeps going up. And you have to sit there and watch it go up, continue, and see all the profits that you could have made. That situation can weigh pretty heavy on the emotions. And that's something that I've experienced so far with a stock called Afterpay, the very infamous Afterpay. I started buying in 2018, so a couple of years after I first got investing and started getting a bit more of a knowledge. And I thought, okay, this is a really good product. What they're offering is really good, and I can see it taking off. And it did. I got in the teens and rode it all the way up to about $40, $41. And that was until this year. And then obviously COVID-19 hit, and then everything started tanking. The whole market just started tanking. But I was still, throughout that whole period, I was still confident in my decision in this company. And so it dropped down to about $8. So I was negative territory. But along the way, and this will tie into my next point, number 3. Along the way, I just bought increments and increments and just kept increasing my size as it went down. So I got some in the teens again, where I first initially started. And then I bought some at about $9. And the bottom on this thing is $8.01. So in a 52-week range, this stock has gone from $8.01 up to $95.50 or something. So that whole spread is 1,200% in profit, 1,200% in profit. So I only captured a small amount of that game, but that will lead into my story now. So as I bought down, I decreased my actual position, as in the purchase price of my position. I decreased it as I kept buying increments lower than my initial price. So for instance, I think I initially bought at about 17, and then the week after I bought, it dropped to 12, and I bought at 12, and then this thing gradually went up to the 40s. And so something that is really powerful that you can harness out of the market that a lot of people just think is too scary is actually dollar cost averaging in. So that basically entails when the price drops below your initial price, if you purchase below your initial purchase price, so when it went to $8, I got in at about $9, that dropped my actual average price lower. So which means you get into a profit faster if this thing comes back up. Alternatively, if you buy lower and it keeps going lower, you see a higher degree of loss, which is not where you want to be. But that wasn't my theory about this product in COVID-19 times. I thought this would really flourish, and it has, seeing as we're seeing the reports come out. The yearly reports are really good, the profits are good, and that is what entailed on the jump from $8 within a few months to reach a high of 95. So I didn't capture all of that move. As I said, I averaged my way down. My price was a little bit lower than when I first initially bought, and I rode that up, took about a third off some of my position in the 20s and 30s, kept the rest of my position and sold at about 56 or 55, around that 50s area. Now, I could have been, I mean, I am really happy that I captured that profit. It's about 200 to 300% profit. So I'm really happy with that. And through this time, I've been able to spread those profits to other things and make more profit, which is the power of the market, right? But what I can't help but deal with, and I have dealt with this in the past for previous stocks, is the emotions of getting out in the 50s and watching this thing make another $40 in profit, what could have been an extra $40 in profit on my initial position, which is quite a large sum of money. But something that you have to deal with, and you'll probably have to deal with, a lot of people out there will have had to experience this, is selling, being happy with your profit, sticking to your goals, and making really concrete goals and really concrete points, whether that be a percentage or that be a dollar figure for the stock, and actually saying, if it gets to here, I'm happy, and whatever else happens, it is what it is. That's the attitude that you really have to adopt if you want to get through this. Otherwise, you'll sell out of fear all the time. You'll see something drop. You'll be so scared that you just want to get out of a position. And sometimes, that is what happens. Sometimes a stock will come out with really bad news. They'll be making a massive loss, or they'll be saying, we're going towards insolvency. We don't have many assets in the bank. We're starting to lose all our employees. We're starting to sack employees. And that is not a place where you want to be. You don't want to be exposing yourself to that sort of risk. But none of that news had come out for Afterpay. Everything that I had seen in the news, not the mainstream news, but the research that I had done and the reports that they were releasing was really positive. I didn't see any bad signs. Hence why I added to my position, even though the stock price was falling. So that really emotional side is the mistake number 2, which I suppose isn't really a mistake because I still made a profit out of the situation. But that mistake of selling too early is sometimes something that can weigh really heavily on the emotions. That pretty much wraps up number 2, the second mistake that I've made, basically selling too early when you could have captured a large portion of it and having to deal with the emotional side of seeing the stock increase after you're out of your position. And of course, I can always get back into that position if I want to. If I see a massive pullback, I might be interested in taking another position there or in the whole buy now, pay later sector altogether. But just for me personally right now, out of my own personal, I suppose, sentiment, I'm not interested in that sector right now. This, of course, brings us into topic number 3, which is trying to pick the bottom, the infamous bottom of the stock market that people always try to pick and somehow can never get right. Some people can, some people with amazing intellect and people who study the markets every day in and day out can pick the bottom, but people who want to sometimes can't. And it's a joke in the financial industry that, some people pick the top, buy at the top, and then the stock starts to drop and they'll sell out of fear, and then it'll hit a bottom right as they sell, and then it'll pick back up, and then they'll buy in again, and they'll basically just continue that cycle of buying the top and selling the bottom out of fear, and they'll just continue that cycle until they're broke. I mean, it's pretty common. It's not something that, everyone can avoid, and some people just can't deal with the emotional aspect of, holding it through a period of downturn and then leveraging their position to enhance their position and strengthen their position. This sort of ties into what I was mentioning in topic number 2 in the terms of dollar cost averaging. So if you buy at the very top, no problem. It's okay. You do it. It happens to the best of us. And then as the stock starts to drop, you can actually leverage your position. Like I was saying before, if there's no bad news and it's just a stock market cycle, you can actually buy into that position and reduce your actual cost of the stock. So for instance, if we bought up at the very top, $10 a stock, and then the stock starts to drop and it dips down to 7, 6, 5, if you bought the same amount of shares, let's just say 1,000 shares at $10, 1,000 shares at $5, the same weight, the same amount of shares, you now have 2,000 shares at $7.50, $7.50, because you've dropped your cost from $10 to $7.50 by buying at 5. I hope that makes sense. It's a very simple concept to understand, but a lot of people just don't use it in the industry. Now, in saying that, this is not a strategy you would use if there's some unforeseen circumstance that is affecting the stock, or they're sacking employees, or they're making a huge loss. There's talks about them going bankrupt. That's not a strategy you would use in this instance. You would only use that if your initial reason for buying the stock was that it had value, you saw value in it, and whatever it may be. People may use it all the time. It's not going to go out of business anytime soon. That strategy would work in this instance for the simple fact that the stock price isn't reducing for any reason other than just the simple fluctuations in the stock market. That is the simple reason behind it. I've just put up a chart on the screen that depicts what the top and what the bottom is that I'm talking about. So this will be in terms of a stock that at the very top, as you can see on the screen, there's been multiple points where the stock has tried to break through and make a new high, as in increase out of the current cycle that it's in. And along the bottom, you'll see areas of support where the stock has hit a certain price, whatever that may be, and it is bouncing off that point multiple times. So what I was saying before is some people buy the top, it'll get to a point where it's at support, and they'll sell it just based off fear, not any other reason, just they don't like seeing their portfolio be in the red. That is the only reason. And people do this, and people lose a lot of money. And I'm not a technical analysis expert. I know just the basics, the simple basics of technical analysis that are enough to get you by. So, like I was saying before, you can use your prior knowledge and a basic technical analysis standpoint to understand the cycles of a particular stock or the stock market in general. Whenever it's nearing resistance, it can either do one of two things. It can break out from the current trend and the current channel that it's in, or it can turn back down and look for another area of support that it can bounce off. That's about as simple technical analysis as you can get. That about wraps up. Number 3, the very third mistake that I've made before is selling out of fear. When you're trying to pick the bottom, sometimes you don't get the bottom, sometimes you get the top, and it just keeps dropping and dropping and dropping, and you can sell out of fear. I've done that. Everyone who has invested has sold out of fear before. It is just some innate human ability for us that you can deal with it. It is possible to deal with it, but sometimes when we're first starting out, that's one of the factors that can really affect us in our mental state, is just the fear of losing the money, seeing the portfolio in red, and sometimes it just takes over and we sell the position. I really hope you guys enjoyed this video. I hope you like having a laugh at me or having a laugh with me, whichever one it may be. I'm certainly not fussed, but like I said, anyone who hasn't made one of these mistakes out there, they're probably lying to you, or they're the best investor in the world. It's just something that we all have to deal with, and the mental aspect of trading, the emotion that's attached with your own money is something that is incredibly strong, but if you can overcome it, you can unlock some really good profits and some really good strategies in the stock market. Hope you guys are having a great day. I'll see you on the next one. Thank you for watching. See you later.